Everyone interested in charting finance, April 7th, 2025. And it's been an interesting few days. It's actually been an interesting couple of weeks for me because I've been working on updating the tool quite a bit. I came from a background in state sales tax across all the 46 states with some sort of state sales tax, and I have transferred to federal income taxes. So I think I've got both the state and the federal in mind, and that's Otto saying congratulations because that was a lot of work. All right, hold on one second. With Otto are ongoing, but I promised him his own trailer, actually his own couch, which he's checking out right now. So we'll see how long this goes. So the tool itself, like I said, I put in a bunch of federal income tax calculations, and I've also updated it to make it easier to do A/B comparisons. And the comparison I have in mind is when should you continue renting, or when should you use that down payment to buy a house? And in the process of answering that question, again, I had to get all the federal income taxes, and I had to wade through all of the amazing data out there, economic data, really by the St. Louis Fed, but also the BLS, Bureau of Labor and Statistics. Just some incredible stuff out there. I've only scratched the surface on it, but I'm using this source of information to get average income, average expenses, home prices, and I can dive deep into it. But since I've got these averages, I've got my new federal taxes engine going, I wanted to start seeing what it would mean by applying this model and running through different series. Like, what does it mean? And the first one I want to start with is just the average price. So given an average income, average expenses, average home price, which $420,000, what that would mean. So that would, 20% down, that'd be $84,000 that I could either put towards a down payment traditionally, or into the stock market and let that grow over time and continue renting. Now, recent events, of course, are always possible, and the answers that we get by running through the model and over historical data is one thing, and then you have your recent events, and that's another. But we'll go with the model and the historical data and see what it says. And like I said, we'll plot out a series of this to see what the low and high ends might mean for making that decision. So let's start. What I've done, we'll bring up the A recall, just like your calculator, and we plugged in the average monthly income according to the St. Louis Fed and the average monthly expenses, same data source, and this $84,000, this is based on the average down payment for an average home. So a 20% down payment on a $420,000 home. So that comes out to $84,000. I've got my income and I've got my expenses. And you might notice that your asset view is doing something that is basically saying you cannot afford this lifestyle. Even with that $84,000 to start with, we're basically spending more than we have. And we end up, after the end of 10 years doing our test, our finished asset value is a little bit over $11,000. So this would be a case where I did not buy a home. I chose to put that $84,000 into the stock market. I had amazing 9% annual returns, and that was not enough to escape my very extravagant, apparently, lifestyle. And again, this is from the St. Louis Fed. So this is what's going on out there today. And it's kind of indicative that not everyone is enjoying the same robust wage growth and economic environment that the average is. Well, that was the case for looking at rentals. What about for houses? So if we go to B recall, which is what I've stored my housing information is, again, also from the Fed, you can see that here's that $420,000 average home value. The mortgage, $336,000. So that $84,000 as a down payment, 20% down payment that went to the mortgage. My monthly income is the same, $69.64. My taxable account starts at 0, and my monthly expenses are the same, minus $59.90. So what does this one tell us? This is a little better in a way, although it's still somewhat fantastical, because you'll notice that I'm actually dipping into my taxable account in order to fund my home-based lifestyle. I do end up positive overall because my home is an asset that's appreciating, but I'm really doing this by somehow letting my stock accounts go negative and having a loan essentially at 9% a year, which, this is good for the mathematical model, but this also shows that a average person with average expense, average household income, average expenses with an average home, can't really do that right now. So that's an average problem, I would say, for the average American. Data back from the St. Louis Fed. I made a calculation, having gone through it all, just using the Fred's groups that they identified, the 40 to 50K, 50 to 70, 70K to 100K, and these are annual household earnings, 100K to 150K, 150K to 200K, 200K plus. So I thought, all right, I'll try to match these, sestiles, is that right? For six that these you kind of group these into, and if the 70 to 100K range represents the average house of 420,000, then I would sort of build off of that, or deflate that for my smaller amounts, and just see what different income groups with buying a house or renting, what that would mean for them. So we plug in these numbers. We did 69.64 for income and 59.90 with a start value of 84,000 in a stock account for renting. Well, we're going to do the same thing now, only we'll do 10,151 and 75 plus with 105,000 into the bank account. So the price of our house went up a little bit. That's what we're going to have in the stock account, and let's see what that looks like. We actually have some good news. Happy to report. If we're in the 100K to 150K range, plugging in the average monthly income of 10,151, the average monthly expense of 75.56, and here basically a down payment. We inflated the house price up to 525, so our down payment got correspondingly bigger to 105,000, and we put that as our seed money in the stock account. We can see that if we run that through the model, now we're actually cash positive. So it's good to be making six figures in the U.S. In renting. So we see after 10 years, 240,000, and we actually have growth, real annual growth of 8.6%. So this is great. Now I'm cash positive. I'm building wealth, and this is a strategy you can actually live with. So that's the renting situation where I put that down payment into the stock market. Let's look at the buying a house situation. So same inputs as far as the income and your monthly expenses. This $105,000 we're going to put as a down payment to our house. Remember, our house is going to cost $525,000. So we go to my presets, we build it out. Okay, 525. I have a mortgage of 420. Let's find out how it matched the same number as our previous house. Start values, and we see we end with $448,000. Well, that's a little bit more because our annual growth is 15.6%. So that's quite a bit more. Now, you can, I do want to make clear, like, this isn't necessarily an apples to apples examination, because there are some trade-offs with owning the home versus renting. Maybe your property taxes are higher, or your maintenance costs, or there's myriad sort of things you can tweak and adjust stuff. Let's just do this, for instance. Let's say it's going to cost another $500 a month between property taxes or maintenance, or whatever. So this will put our monthly expense up to $88,056. If I recalculate, well, now we're down to $261, and that's a heck of a lot closer to what the renting scenario was. Now it's only $20,000 difference. So, I mean, is that the exact scenario that you might be facing with? We'll see. But even that small change, $500 a month, can bring this more in line. But it was important to note, all things being equal, we did see a higher growth rate with the buying the house versus the renting a home. So now I could take you through the other ones, but I'm just going to show you that series at the end. However, I am going to show the richest set. And a couple of guesses you might put into the comments first, which you think is going to win. Go ahead, add to the comments and hit like while you're at it. But what do you think? Is at the top income level identified by the Fed, will it be better to rent and invest or to buy that home? Let's find out. We're going to go right to row 7 here from the data that we pulled from the Fred group, the 200K plus household income earners. And they've got a monthly income, almost $28,000. Monthly expenses, $14,500. The start value, remember, we're going to increase the price of our home. It's actually going to be a little bit over $1 million now for the home they're going to buy. So 20% down, it's going to work out to $210,000. Only this time, we're going to look at the renters first. So that's going to go in a stock account, and we'll see what that looks like over time. And here it is. We can see that they did quite well with, I believe that is $1.6 million at the end of 10 years. Basically buying that home and adding to the stock account. That's an annual growth rate of 22.689999%. So that's pretty good. It's nice to earn more than $200,000 a month or a year, and over almost $30,000 a month. So that's a good way to live. Now let's see if I had done that same equation with the house. This $210,000 I'm going to put as my down payment towards the mortgage. So the house is a bit over $1 million. The mortgage is $840,000. That is a bit above the $750,000 cap. So we've actually maxed out our deductions there. There is my income, and if you actually went past and you skipped and you looked, you can see that I ended up with over $2 million in this scenario. 25.8% annualized return. And here, let's just see, just for grins, let's add another 1,000 on top of this, so 15,000 a month, because maybe my property taxes are more and all that. But I still, I'm actually, I'm separating the distance between the renting scenario and the purchasing scenario is getting wider and wider. And basically, it says, like, as your income goes up, you definitely want to be in assets, because the subsidy has a much better discount, because you're being taxed at a higher rate with a higher income, but that's the discount you're getting from the subsidy. So hopefully that helps at least point to a direction you can look at when pulling data compiled by the government, running it through a model to see what various segments, what you can expect for returns. And I just wanted to share the series that we ran from the Fred group data with the monthly incomes and expenses. And this is the rent that we're focusing on. And you see the progression. I think we started out at the row 4 here, which was the median house. And as we go up the scale in income, and even with purchasing larger houses, we can see that 8.5, 13 plus, 22 some. Things get better as the more your income grows. Who knew, right? And then if we look at the house scenario, so take a look at that CAGR on the far right, we see it goes up even more. When you're buying the house, because you're getting those subsidies, and it just works out really well. And this is where having a model, we can look at all the intricacies of the individual parts, but the model does that for us. And now we can just start putting in the numbers, income and expenses and houses, and seeing what the results are, and seeing that all things being equal, it's good to have a home. Take care.